Hello, and welcome to your Daily Five. I'm Greg Harmon, founder and president of Dragonfly Capital. At Dragonfly Capital, we sell a newsletter that gives those that want to trade their accounts on their own some help with ideas and some help with technical analysis and option strategies. We also run separately managed accounts for clients that don't want to do it on their own and would prefer that I manage the money for them. You can find out more at dragonflycap.com. Well, continuing our theme from last month, it's a bull market, baby. We're still in a bull market, and it's looking stronger and stronger. How strong could it be? Today, I wanted to talk about the longer view, looking at some macro monthly charts. And bear with me, please give me a little leeway, even though we've got 3 days trading left in the month, that the charts that I show you for do include January, and that it shouldn't be a big deal that they'll still finish looking very similar. First chart I wanted to talk about is the US dollar index. And the US dollar index has been one of the factors that have helped the market over the last year, since 14 months, since October of 2022. And we see that what's happened since that late 2022 timeframe is that we've got the dollar losing a little bit of its power. And we see the backup here that we had in the middle of 2023, where the market corrected for a little bit before. If we look at the big macro picture of this, though, we had a move out of a symmetrical triangle in 2014 up to a new zone, some consolidation in a new triangle, and a similar move out of it that is what led us to the peak that we saw in 2022. The pullback here now seems to be consolidative at the moment, as opposed to directional at all. And that's reflected in a few things, right? The moving averages are starting to get flat on the monthly basis. The Bollinger Bands here have squeezed in, and they're also flat. And we've got momentum gauges. We've got the RSI right at the midline, kind of telling us nothing. And the MACD still positive, but pulling back towards that zero line. It looks as though, as long as we stay in this consolidated range, somewhere between 101 and 107, that this is going to continue to be a tailwind for equities. The next chart I wanted to talk about is gold. And gold, we see on this monthly scale, ran up to a peak there in 2020, right after the events around COVID started happening. Bounced back up there again 2022, and had consolidated underneath there. What's the saying we say quite often in the technical analysis space? There's no such thing as a triple top. Burst through at the end of last year, November and December, making new highs. And now we've come back to retest the breakout area. So the classic example that we see from TA textbooks, et cetera, would be this kind of a consolidation, breakout, come back to retest the breakout, and then a go. So look for that possibility into the future, as long as we don't crash down through 2000. That is the market for gold is set up to continue to look pretty strong. The third kind of influencer of the broad equity markets, bonds. And I went back to 1990 here to show that we had this 30+ year bull market for bonds running into channel. We had a little bit of a whoops kind of breakdown that failed here in 2018, the end of 2018, if we remember what was going on then, markets moving backwards as well. And then we've got the final crash that started this downtrend, or what I'm calling a cyclical bear market or maybe even a secular bear market in bonds that has been in place for 2 years now. With all the excitement that happened towards the end of 2023, really just showing that we've bounced up to a lower high in this downturn. So in my opinion, still a secular bear market. We've got momentum is refusing to get above even the midline here and is deeply negative on the MACD. If you can't count on bonds, then what else do you have to count on? As an investor, stocks. And we see the benefits have been accruing to the equity markets. So if we look at, first off, the Nasdaq 100, and this reflects up till this morning, but it's still a relevant range here. We've got the big run up that's happened from 2009, the 2009 bottom after the financial crisis. Geez, the financial crisis crash doesn't really even look like anything on this, does it? Running up to the peak that we saw in 2021, had a nice 38.2% retracement of that range and some consolidation there through 2022, the end of 2022, the pullback, and now we've got a move back higher. If you want to get a little bit imaginative and think about this as a potential Elliott wave going back up, a positive Elliott wave, we've got maybe wave 1 with the corrective wave 2. Wave 3 would then have to be much higher to outweigh wave 1 that went from 11,000 to 16,000. So if we even equal that, that would be a move up to 18,500. So well above the range we're in now. We also see we had a cup and handle form here that says that we've got the opportunity to go from about 11,000 to that 16,000, another 5,000 from the pullback or from the breakout here, and 16,000, 5,000. That's a move up to 21,000. That's quite a range of possibilities should these patterns play out the way that some of them historically have. And it shouldn't be a surprise. Technology has been leading the way, with the Nasdaq 100 being the big leader, the home to almost everyone, maybe every one of the Magnificent Seven that have been driving markets. Finally, the last chart here is the S&P 500. The S&P 500 I've got further back as well, but let's look at and focus on the low from the financial crisis up to the top for the end of 2021, pulled back not even 38.2%, but back to its 50-month moving average before consolidating and moving back higher, breaking out now. It also has this cup and handle in there, and the cup and handle taking it from 3,600 to 4,500. If you take that another 900 on top of that, that's a move up to 5,400 in the S&P 500. And you can see here, we're right around 4,900 now. That's another 600 points or 500 points, or more than 10%. So momentum is looking really good here. If we look at the MACD, it had reset almost completely back to zero. So it's got a lot of room before it gets anywhere near the peak that we saw in 2021. And we see also on the RSI that there's a good bit of room here as well. Before it gets into overbought territory, with the Bollinger Bands starting to open up. So I think that there's a strong tailwind to equities over the next, I don't know, several months, year, I don't know, who knows how long. But the charts themselves look like they are primed for big moves that could continue. And as long as we don't get any, exogenous surprises here, I look for that to continue. That's your Daily 5. Thanks for watching.